Hello, everyone, and welcome to my YouTube channel. Today, it's a tremendous honor and a great pleasure to have with me Danielle DiMartino Booth. Danielle DiMartino Booth is CEO and Chief Strategist at Quill Intelligence. She is also the author of this fantastic book that all of you have to purchase right away. It's called Fed Up. And Danielle, thank you so much for being here with me. How are you?
This is a great first. It's great to be here. How are you?
Very good, very good. Tell us a little bit about the current state of the recovery in the United States. How do you see the economy right now? Are we living in an environment in which there's too much hype about the recovery? I see that the IMF is expecting the US economy to grow 12% in a couple of years. What's going on, and give us your view.
So the best characterization that I've seen recently is we know that we have monetary policy going full bore, continues to $120 billion a month that the Fed is growing its balance sheet. At the same time, since we've had the original CARES Act, we've pumped about a quarter of US GDP into the system with fiscal stimulus. This is beyond anything we've seen in post-war history. You're talking about nearly $6 trillion here. And so, right now, I think what we're seeing is that we're in the midst of one of the biggest sugar highs the US economy's ever been on in its existence. It would be mathematically impossible right now, given the sheer amount of money that is being pumped into this economy, for the GDP forecast to not be where they are. We are printing our way, literally printing our way to kind of a very short-term burst of prosperity right now.
And one of the things that we're hearing consistently and constantly by the mainstream and consensus in general is, well, what's the problem? There is no inflation. However, inflation is starting to creep up. We're starting to see that gasoline prices are up 22% year on year, that food prices are up 3.5% with the latest figures published.
So I think a lot of what, in fact, this is a graph that we ran yesterday. There's no predictive power of inflation, of households' inflation expectations over the next 12 months. They literally walk hand in hand with gasoline prices. Sure. And if you want to think of the shock to household psyches in the past few months, not only, I live in Texas, where the economy has basically been reopened most of the time, but for many US households, not only have they reopened their part of the economy, but they haven't seen a gas pump in months and months. Yeah. So, in the 8 months through January, gasoline prices were kind of in between a $2.50 range. Now they're at $2.95. Yeah. Once you hit that psychological $3 barrier, you're starting to hurt in American consumers where they see inflation the most, which will turn out to be they might spend less on other things as a result. Yeah. Because now that they've tasted fresh air again for the first time, they're not going to be put back into their homes. So I think that this idea that the demand for gasoline in the United States is certainly going to be there. I'm not so sure about globally and the demand for oil. A lot of other parts of the world are in a very different place right now. Their handling of the pandemic is extremely different. You ran a great chart on Twitter that showed that it was kind of odd to see an economy as large as Brazil's, with its manufacturing sector looking like it's flirting with going in, entering into contraction territory. So there's a lot of the rest of the world that's going to factor into demand for crude oil. Yeah. And you're starting to see China come out very strategically with less demand for copper. Yeah. So this spike in the commodity cycle, it could very easily be narrated away on the part of China, and that would be so convenient, given they're finally in a place in their own supply chain that they can pounce, that they can move in and recoup the lost market share that they lost from US suppliers, starting not just with the post-pandemic world, but with the post-trade war world.
Yeah.
So would not surprise me to see a little bit of tempering in this commodity super cycle narrative that had become so accepted. So anytime anything is the crowded trade and the accepted consensus, I always kind of bristle and say, wait a minute. If everybody's in agreement, where should you be, Danielle?
Absolutely. Absolutely. One of the things that worries me about the narrative that we hear every day is this idea of a savings glut that is going to explode into consumption in most of the world, particularly in developed economies. Because if inflationary pressures on the goods and services that we purchase on a daily basis are as relevant as they are in an environment in which real wages, jobless claims, etc., remain still very, very challenging. No, I think that very few people are just going to go out and spend like there's no tomorrow, particularly because this, at least in the Eurozone, for example, they talk about this massive savings glut. Yet, if you strip it out and you bring that massive figure to the average by household, it's about a 3% increase in the real disposable income of a family. So it's not that much of a savings glut anyhow, with those pressures on inflation. So how do you see that recovery of the services sector, apart from the reopening, which obviously has an impact? But how do you see that happening, and particularly with the different spectrum that there is out there of jobless claims for the United States? Where do you see unemployment moving in the next couple of quarters?
So, we're in very different times than we would normally be in. In fact, for me at least, it's difficult to call this a recovery because we never really had a recession in the truest sense. We never did cycle through and put the companies out of business that were zombies and take all of the excess capacity out of the system. The Federal Reserve's policy with their corporate bond bailout prevented that from happening. So right now what we have is very much a fabricated recovery. And we have to bear in mind that 1 in 4 US families making $175,000 or more coming into the pandemic had no savings.
Yeah.
So it was very much a phenomenon where a lot of high middle income earning families were faced with the reality that they had spent most of their careers spending but not saving adequately. Gotcha. So I think that for those who do have a little bit of excess savings set aside, and I'm not talking about the wealthy who obviously dominate these average inflation figures, which is a whole different discussion, but they obviously obfuscate the ability to see what the median US household has in terms of household saving. But I think a lot of upper middle income earners are going to be comforted going forward to know that they have less debt and to know that they have a greater rainy day fund, because that's something that the pandemic taught them. You grow up hearing you should always save for a rainy day, but it never happened. And so we've never seen a severe recession in a post-Greenspan era because the Fed always ran to the rescue. That changed. So it will be interesting to me to see how much of this pent-up demand sees services follow through. My good friend Michelle Meyer, she's chief North American economist at Bank of America. They're able to see inside of checking accounts of stimulus check recipients. And from everything that they can surmise, it looks like day 6 is when they hit total peak consumption from when those stimulus checks first hit. And then spending is coming off. On top of that, you have a tremendous spike in February revolving credit. On February the 3rd, most Americans learned that the Democrats were going to have the sufficient votes in order to push through the next $1.9 trillion. So your average American family sat down, they did the math, they looked at the calendar, they said, well, spring break is in March, but we know we're getting the money. So we're just going to go ahead and charge it on the credit card. We're going to buy the airplane tickets in advance. We're going to book the hotel in advance. We're going to buy the theme park tickets in advance. And that's indeed what we saw with a 10% spike in credit card spending in February. Yeah. So a lot of American households even spent that money forward. Yeah. That it's going to be generating that impulse in rising services inflation. As for the follow through, even if you look at the Fed's own estimates, by the time we get to the fourth quarter, I don't know that consumption is going to last that long, but by the time we get to the fourth quarter, you're already back down to trend growth in GDP, and you've got unemployment benefits running out again on September the 6th. So we've come through, Daniel, we've just come through the largest quarter of mergers and acquisitions in the first 3 months of 21 in US history. And that means that as many permanent job losses as we've seen, and right now we're looking at the highest level of people who've been out of work for 27 weeks or more post-pandemic. That's the highest level that we've seen as of the March non-farm payroll print. That number is going to increase as the synergies are realized, as companies come together to merge and rid themselves of redundancies in terms of labor cost.
Sure. So when you look at this chain of stimuli that we have seen, that has we've grown accustomed to this idea that, you know, oh, if it's only $1 trillion, it's not enough. We need to do 2 trillion. Now, so basically, you know, if we $1 trillion here, $1 trillion there goes basically into the economy, and nobody seems to analyze whether it's been adequately implemented, whether the returns are actually good. And you mentioned a very important point, which is zombification, is that we have gone through this process without any single real cleanup of the areas that had overcapacity, which were substantial already in 2019 and 2018. And what we have basically done is perpetuate that level of overcapacity and increase the level of non-productive debt. No? So obviously, we in the Eurozone look at those things, or the people that at least are a little bit more critical, and see, oh my God, we've done this before.
So, you know, it's interesting. You know, you have cruise lines that have a ton of ships that are looking to take this state or that state in the United States to court, so that they can pull those cruise ships into the docks and fill them up with people again, so that they can stay in business. They've blown up their balance sheets the entire time in the background. You can say the same of many big gambling outfits, some of which should have gone completely into restructuring in 08 and 09, but didn't. And they're still kind of with us. But in 2020 alone, it looks like non-financials in America tacked on northwards of $2.5 trillion more debt in order to buy the dead patient more time on life support effectively. And so we have to live with that drag on productivity. And at the same time, unlike how China approaches infrastructure spending, here in the United States, we have to put that in air quotes, because we have some of the most dilapidated bridges, tunnels, airports, you name it. And we're only going to put a very small portion of this next 2.2 trillion into truly updating the infrastructure in this country, which would create jobs, by the way, and high paying jobs. But this is spending that's going to be spread out over 8 years. It's old school Washington, D.C. It's made by the same tired old politicians who crafted the same legislation coming out of the financial crisis. And so there's not much to be expected in terms of productivity generation there either. And that gets us to the September the 6th deadline for the special unemployment benefits that have been extended since March of 2020. And it looks like, if the Senate parliamentarian, who's an unelected official, has said that the Democrats are in their rights to pass 3 separate legislations in 1 calendar year. That's never happened before in US history. So if the Democrats' last bullet in their chamber is extending those jobless benefits from September the 6th forward, we'll be into an election year with no new stimmy checks. At some point, a gentleman by the name of Joe Manchin, who's the most powerful politician in all of the United States of America, has already said he's going to pull the plug, because he's not seeing improvement economically, but rather constant spikes in spending generated by stimulus spending, but not enough in the way of good paying jobs. Most of the job creation we've seen in recent months is coming back into leisure, hospitality, restaurants, bars, casinos. These are all low paying jobs.
Sure. One of the concerns that many people have is actually that the job creation from these big infrastructure plans is also very temporary, because most of the money goes to companies that are already working at maybe 60-70% capacity. They're not going to hire for the long term, and even worse, most of them may even not hire at all. They will just take a project that will make them go from 70% workload to 80% workload, but that's it. No, and that's what ended up happening, for example, both in Japan or here in the Eurozone. The deficit is going to balloon anyhow, and even with this completely science fiction mathematics of fiscal revenues that I saw from a few headlines out there that say that this plan is revenue neutral, is completely impossible to be revenue neutral. But even with that, the deficit is going to continue to be enormous, which means that the Fed might be hostage to a government that is not just not willing to reduce deficit, but is going to continue to increase deficit as long as they feel that interest rates are going to remain low. So the Fed's only policy seems to be watching how much they need to buy of government bonds, instead of whether unemployment is within the range and the growth is within the range, and inflation the same. So do you think that there is a risk of that Japanization of the Fed, in which it basically becomes completely hostage to government spending that is simply ballooning and will not change its course because mandatory spending is going through the roof?
Well, I think that the risk is certainly higher than it's ever been in U.S. history, because for the first time you have a former chair of the Fed who is now Treasury Secretary.
Yeah.
And so Janet Yellen already has mapped out in her mind what the game plan should look like going forward. People forget that Jerome Powell, before the pandemic and before not QE and the seizure in the overnight lending markets, and the meltdown in the markets in 2018, which greeted him in his first year in office, people forget that he is a Republican. So he does not like to have his integrity hijacked in order to support fiscal spending indefinitely, as you describe. And we have no way of seeing into the future, but it would not surprise me if at the end, if the time we are into the holiday season this year, that we hear that the Biden administration is already looking to replace Jerome Powell with somebody else who might work more hand in hand with Janet Yellen. But Daniel, I will tell you that the warning is that the closer that we get to a situation where we're spending in perpetuity and it's de facto socialism to keep people out of the workforce, the closer we are going to be forced, because of what China is doing, making very rapid inroads with China, with central bank digital currency. You could see a situation, especially again, if it's not Jay Powell, but somebody else running the Federal Reserve, where there's a partnership founded between the Treasury Department and the Federal Reserve. And you're not talking about effectively monetizing deficit spending, but actually directly monetizing it. Two very different, very, very different things. Huge distinction in between them, implication being that individuals have accounts directly at the Federal Reserve. And then we stop talking about cute subjects like hedonics and the consumer price index understating healthcare and understating housing, and how the numbers are monkeyed with. All of this in and around the 2%, 3% range discussion goes out the window if we cross that Rubicon. And then you have actual inflation. And you have China sitting back saying, we forced the United States into this, which is why there is such pushback when it comes to central bank digital currencies, because it takes you to a whole different level of discussion, because eventually you're talking about a new financial system in which the dollar hegemony doesn't necessarily have a place.
Absolutely. Absolutely. The risk of the central bank digital currency is so enormous that people don't understand the implications of basically a central bank that is not just printing all the money that government wants, but also directing money wherever it considers politically correct and politically acceptable. We've seen, for example, that China's digital currency is aimed to have a sell-by date, no? And that it becomes fungible after a period of time, and that it's directed according to the political or allegedly social situation or eligibility of citizens. So it becomes very, very risky, because all of this enormous deck of cards that we've been talking about, massive deficit spending, a level of growth that is higher than the average of the developed economies, a certain level of unemployment, etc. All of that goes down the drain if the confidence in the US dollar is lost and it loses its reserve currency status. And as you were pointing out, China is basically moving the United States into trying these Argentine-style great ideas of printing to prosperity with that in mind. Do you think that that is a big risk, that the United States could lose its world reserve currency status?
Well, so again, follow very closely the changing of the guard or lack thereof at the Federal Reserve. Sure. If Lael Brainard's position opens up on the Federal Reserve Board and room is made for Kenneth Rogoff, who has written about the eradication of cash and who has written about penalizing savers in best-selling books, that's not Chinese and that's not communism. Those are ideas that were homegrown in the United States for penalizing savers for holding cash. Yeah. So those types of ideas already exist in the dialogue among current United States central bankers, big economics thinkers. So the changing of the guard at the end of this year is going to be so critical, because Rogoff has said publicly before that Japan did a poor job of imposing negative interest rates, and that with a better educating the public as to its virtues and attributes, that it could be better done in the United States. I mean, these are the things that make the hair on the back of your neck stand up. And yet there are people in place who would have come into a Hillary Clinton administration had Donald Trump not won the election. But these are just the facts of life. If it's just been a matter of pushing this on pause, and you have the correct individuals in place, Janet Yellen at Treasury, Lael Brainard as Fed Chair, Ken Rogoff on the Federal Reserve Board, you could have the right cast of characters to have a situation where it's China and the United States penalizing recipients of funds for holding anything extra in their accounts.
Certainly, certainly. The famous quote of how to make negative rates work, in which Rogoff mentioned how negative rates had not worked. In fact, they had led consumers and companies to be more prudent, obviously, because Japanese...
paradox of thrift.
Absolutely. Everybody says, why are the Japanese not consuming more or spending more? Because they're not stupid, because they know history, because they know that the government is going to debase the currency long term. So they become more prudent, not less prudent. So the idea that a central bank is going to tell people how they should behave because that's good for them. It reminds me so much of hearing the central bank governor of Argentina telling people that it's evil to save in dollars because they should save in pesos, which obviously are destroyed in their purchasing power in a few months. So the concern that I think you're pointing out very, very well is that by now, the warning signs are at least out there that there is a new and different way of approaching monetary policy. That before, and it's important what you mentioned, quantitative easing, through the credit mechanism, at least has a number of backstops that prevent the inflationary process to happen as aggressively, because we as consumers might decide to take more or less credit of that money supply. It generates.
Banks may not lend as much if they choose not to lend as much. The old proverb, you can take a horse to water, you cannot make it drink. Blowing banks up with reserves, we know at this point, does not necessarily generate lending and grow the economy.
Certainly. But now what you do is you wipe out the credit mechanism. You wipe out the transmission mechanism of monetary policy that at least had those levels of backstop that included some demand into the supply picture, and you simply flood the economy by directing government spending. I think that big risk comes at the forefront, particularly when we're looking at markets, because one of the points that I'm trying to make is, what do you think is the outcome once you reach that situation? Because right now markets are working fundamentally on the idea that stimulus generates higher growth and inflates multiples. But what do you think happens when you suddenly merge and destroy that credit mechanism?
So we're going to know fairly quickly, because we have real-time data that comes out every week. Every single week we learn from the Department of Labor what the jobless claim statistics are. So we'll know fairly quickly if the September the 6th fiscal cliff is going to be a subject of discussion, such that we need to talk about yet more support for households who remain out of work.
Sure.
So and markets are forward-looking mechanisms. We're going to have a blowout first quarter earnings season. We can see that.
Yeah.
But at the same time, the massive supply chain disruption, the massive shipping and freighting cost spikes, companies are going to be saying, just like WD-40, which is an American institution, said last week when it reported its earnings, we've missed on our bottom line because we were not able to pass along price increases
Exactly.
to our end users. So companies during the first quarter earnings season are going to be warning of margin squeezes, as well as, we can't see what revenue is going to look like going out into the third and the fourth quarter. We have very little visibility because so much of the economy has been floated on this stimulus. And now the animosity politically in Washington is such that the GOP is not going to give one vote for any legislation of any kind. So everything's going to be straight down party lines. Sure. And create more animosity yet. So to me, the way this plays out in the markets is people begin to anticipate. Jerome Powell looks very nervous and very tired when he's at the podium these days. People begin to anticipate a changing of the guard and what the implications therein are. And if we are going to see a situation where the powers that be in Washington, and bear in mind, Janet Yellen is a University of California, Berkeley educated labor economist. That's who she is. It is in her bones to try and get money directly to the people. Yeah. If the mechanism is going to be facilitated in an economy that is buried, I'm not just talking about the sovereign, but the corporate debt market, the commercial real estate market. I mean, we are in an environment in the United States where rising interest rates are simply not an option.
Yeah.
You may as well be at DEFCON 1. So in such an environment, markets would begin to get extremely nervous and foresee a second post-COVID wave of insolvencies in front of them. The bankruptcies that didn't happen, that will happen. Yeah. Some of the most recent legislation that was passed precludes the Federal Reserve from flipping a switch to turn back on the credit facility that bailed out the corporate bond market. People who watch markets closely know that it's not going to be as easy as Janet Yellen flipping that switch back on. Yeah. So you have to have a new emergency in order to give the Fed new powers. And that does not exist in its current form. But that new emergency would certainly get the attention of the markets that will start to look through to what's going to come with this next September the 6th cliff. And we're pushing into May. The summer discussions are right with us.
So basically, there's this two-step process that we're looking at right now. Right now, we're in the hope period, then
Yes.
we're going to be in realization. We're going to understand that the bankruptcies that did not happen will start to happen. We're already starting to see some signals.
We've seen a very steady, high level of bankruptcies in the United States. What we haven't seen is households and smaller businesses. Those insolvencies are much less visible, but we have seen a steady, high number of bankruptcies.
That's very interesting, because this is what happened also in the Eurozone crisis of 2011, 2009, 2010. Everything looked phenomenal. The ECB felt like it was the king of the world. And it was precisely when the recovery was already there that you started to see the bankruptcies happening in a severe way, even. And this is the key thing that probably I would like to touch. What is your opinion? Because it happened just as governments continued to prolong the programs that kept some of those zombie companies alive. So what are your thoughts about that? Do you think that we can actually see that wave of bankruptcies even with the increase or the maintenance of some of those programs?
Well, so you can see deadwood remain in the system for a very long time. As long as your high yield market is truly open, you can see the zombification, because you've really got to get to an emergency point, which we got to in late 2018, because it was a big enough name. October the 31st, 2018, it wasn't just Joe Q junk bond issuer, it was General Electric debt.
Yeah.
that got downgraded on October the 18th. So that put enough of a fright in the market to start to contaminate other issuers. There was a ripple effect. So you'd have to have something that big, I think, to shut down completely high yield issuance, which is still running at record levels. But remember, again, we've just come through Q1 of 2021 was the largest level by a wide margin of mergers and acquisitions in US history.
Yeah.
So many of the ideal, valuable takeout candidates have been identified. And now you ask yourself, what's left? Well, you've got zombies and less desirable marriage candidates.
Yeah.
And so to me, there is still a pool of companies that don't have what it takes in terms of their business models to remain a going concern with sufficient cash flows to cover their interest expense. We'll see if investors begin to be choosier.
Yeah.
And as we saw that first spike up in the 10-year rate that accompanied that initial correction in the NASDAQ 6 weeks ago or so, sure, all of a sudden you started to see Bloomberg headlines of, oh, this deal, this bond offering's been pulled, this bond offering's been pulled, the market conditions aren't quite right. You just have to see that, because again, the companies that rely on the capital markets remaining open, they must remain open. They cannot close. So that's the point where you say, okay, well, wait a minute. Now we've got zombies and bad players together. And you don't know how big that universe is. So, and especially if stock prices aren't at their all-time highs, which has been the currency used to transact so many of these mergers and acquisitions.
Because banks simply cannot lend further because of the risk that they have already increased. So it's about the marginal increase in risk, in risky credit. Yeah.
And people forget about the structure of the US banking system and how very beneficial quantitative easing is in and of itself as a separate line item for the biggest banks.
Sure.
It is a source of income generation revenue. It's a revenue line that they can look at and say, well, the Fed's got QE going on in perpetuity in the background. I don't need to lend to bad credits if I've got this revenue to act as a buffer. And as long as the capital markets are forced open, I can continue generating investment banking fee income at the same time. So I'm still not going to provide that credit that I otherwise might. So again, the Fed's quantitative easing policies have done more than just provide banks with reserves that they don't want to lend out in this kind of an environment. The Federal Reserve's QE policy has also pumped up investment banking, trading, and trading revenue through the actual operation of quantitative easing, because it's against the law for the Fed to buy at auction.
Sure.
So they have to buy off of bank balance sheets.
That makes total sense. And remind people that when the lender of last resort, central bank, and when the issuer of last resort, government, becomes the issuer of first resort and the lender of first resort, the impact that is created once the problem was the diminishing returns of monetary policy go from being poor growth and poor productivity to stagflation, then that's not a very good outcome for investors.
I'll leave you with one thought on that, because
Please.
we are about to come through the most explosive GDP growth since the United States emerged from the devastating 1981-1982 double dip recession. Every dollar of US debt created back then got you about 70 cents on the dollar in terms of a multiplier effect. Today, we're at 35 cents on the dollar. I get that from one of my mentors, Lacey Hunt, but the law of diminishing returns, which you just mentioned, is alive and well in how very non-productive each marginal creation of dollar debt is in trying to generate sustainable growth in the US economy, which is exactly what we're talking about, not constant stimulus spending. So I had to leave you with that, because it's been halved since then, the buying power of the US government's every marginal dollar of debt.
That is phenomenal, because it's exactly we're following Japan so much, yeah, in the Eurozone.
Yes, the numbers are even more remarkable in Japan. The numbers are even worse. Japan is obviously the worst. The Eurozone's worse than the United States, and then there's the United States. And of course, you've seen what negative interest rates have done to the banking systems of Europe, of Japan.
Absolutely. And in terms of the multiplier effect, it's in the Eurozone, it's even worse. Think about it. We had the 2009 job and growth plans that didn't deliver either jobs or growth. We had the Juncker plan that everybody's forgotten. It was hundreds of billions of dollars that were injected into the economy for growth investments. Nobody's talking about that. Nobody's talking about that. And everybody's talking here about the situation as if the European Central Bank has done nothing and that we haven't done enough stimuli. The European Central Bank balance sheet is 63% of the GDP of the Eurozone. The United States, the Fed's is 35%. So yes, we seem to be chasing the wrong number here. We'll wrap it up here. I think it's been an absolutely fascinating talk. What I would recommend everybody is to follow Danielle and to buy her book, Fed Up. And I think that it's absolutely critical to have people like you giving honest, intellectually sound opinions about what's going on in the market. Thank you so much, Danielle, for your time, and I look forward to continue the dialogue with you on social media.
Likewise, and the pleasure is all mine, Daniel. Thank you.
Thank you for watching this video. Please subscribe to my channel, like my videos, leave your comments below, and keep defending freedom. Thank you very much.